Welcome to my channel. I'm going to show you step by step how to value a stock so we can determine whether it's a buy or a sell. At the end of the video, we're going to look at the financial ratios. Leave a comment and I'll be sure to answer. The company we're going to look at is DaVita Inc. This company provides kidney dialysis services serving over 300,000 patients in 10 countries. They have a 37% market share in the US. Let's get started with the model. They have a market cap of $10.6 billion. So that's the value of the company according to the stock market. So it's a pretty good sized company. Their share price is $87. And the way you value a company is you estimate the future free cash flows and then you discount that number back to today's value. That's what we do in this video. Now I'm pulling their actual free cash flows. And free cash flow is cash flow from operations minus capital expenditures. It's the money that's left over to pay dividends and pay down debt. Now I'm going to pull the net income, which is a profit and loss on the income statement. And then I'm going to pull the revenue, which are the sales for each year. That's also on the income statement. Let's take a quick look at the numbers. Well, everything's positive, which is good and fairly consistent. They did have a drop off in 2018 in free cash flow. It could have been a year they were investing in their business. Also low net income that year. Revenue has actually been kind of decreasing. It was at its peak in 2016. But the numbers are pretty good, so we should get a good value. Let's look at a capital structure. They pay $443 million of interest on their debt. Let's go to the balance sheet to see how much debt they have. We'll go to the liability section. Current debt of $130 million, that's debt due within 12 months. Long-term debt of $8 billion, that's debt due after 12 months. Interest payments are tax deductible, so let's get their effective tax rate. Income before tax of $1.2 billion. Income tax of $280 million. So they pay 23% in taxes. Cost of debt is 4.2%. To get the cost of equity, we need the beta. That's how volatile the stock is relative to the market. The beta is 1.23, so the stock moves a little more than the market. Let's get their current assets. That's on the balance sheet. We need this to calculate the current ratio later. And current assets are the assets that you use to run your day-to-day operations. That's $3.7 billion. And that's $1 billion in cash, $1.8 billion of receivables, and $98 million of inventory. We also need the current liabilities to calculate the current ratio. That's $2.4 billion. That's $130 million of current debt, $403 million of accounts payable, $42 million of taxes payable. That's how much money the company owes the government in taxes over the next 12 months. $113 million of accrued liabilities. These are expenses the company has incurred but has not yet paid. Payroll and payroll taxes are a common type of accrued liability. And $660 million of other. Stockholders' equity is the value of the company according to the balance sheet. That's $2.1 billion. And that's $126,000 of common stock, $1.4 billion of retained earnings, negative $48 million of accumulated other comprehensive income. Let's go back to the income statement, get their operating income, $1.8 billion. That's how much money the company makes on its operational day-to-day business. Let's look at a capital structure. 79% debt, cost of debt 4.2%, 21% equity, cost of equity 11.8%, and a WACC of 5.8%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows, that's here in blue. We also estimate a terminal value, which is all cash flows past year 4, that's $10.4 billion. We discounted those numbers back to today using the weighted average cost of capital, that's here in green. We get a value of the company of $12 billion. We divide that by 122 million shares. We get a calculated stock price of $99. They're trading at $87, so they're trading at a 12% discount. So it's a buy according to the model. Let's see what Simply Wall Street says. They're even higher. They're at 117. So they're also saying the company stock is a buy. Let's see what the stock has been trading. So it looks like it's kind of been up and down the past few years, but it's pretty much at its peak right now at $87, but it still appears to be a good value. Let's look at the financial ratios. Good PE, great price of sales, and a weak price to book. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 13. So investors are paying $13 for $1 of earnings. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 0.9. So investors are paying 90 cents for $1 revenue. A price of sales under 1 is considered a great ratio. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 5.0. So investors are paying $5 for $1 of book value. They have a good current ratio, great ROE, and a good interest coverage ratio. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 1.6, so they can cover their current liabilities without having too much assets on their balance sheet. ROE is net income over equity. I like to see above 20%. They're at 38%, so they do provide a great value to the equity holders. Interest coverage ratio is EBIT over interest expense, so they can easily cover their interest payments. They have great ratios, and they're undervalued stock, but I don't have any other companies to compare them to because this is the first company I did in the industry, medical care facilities. So let me know what you think of the video. Leave a comment. I'll be sure to answer. Thanks for watching.